In today's video, folks, we're going to be covering Apple. Now, they just recently reported their earnings yesterday, and they missed those earnings. But today, the stock price is up, not by much, by about 3.5% at the time of recording this video. So it's up to $156 per share. We'll load this up here in the stock spec software, and what we're going to do, folks, we're going to go through the numbers of Apple, figure out their intrinsic value, and see what they're doing right and what they're doing wrong, so you have a better idea where this company stands and if it's worth adding to your portfolio. So here we have it loaded up in the stock spec software just to compare their earnings from Q1 2023 to the Q1 of 2022. There is a slight decrease going from 123 billion down to 117 billion. So a little bit of a dip there. The last few quarters of 2022 wasn't pretty kind to Apple, even though it was somewhat of an increase over 2021. But loading it up here in the financial evaluations section of the software here, and if you want to get your hands on the software, folks, follow the links in the description box below. I think you'll love it. Ranking this company a 7 out of 10. So the software is taking a look at all the company's financial statements over the last 5 years and where it stands currently. So a financial score of 7 is pretty good. It means the company is relatively strong. It's only getting knocked down in 3 different categories. One of them being the price to earnings ratio, sitting at 24.75. The software likes companies that are sitting below a price earnings ratio of 22.5 an average. That is more of a fairer multiple to pay for earnings, because ultimately if you're paying above that, you are most likely paying a premium for those earnings, and we don't want to be paying a premium. And in the trailing 12 months here on the company metrics category, you can see that it currently, the price earnings ratio is 26.06, so higher than our 5-year average. Not looking too great there. The current ratio, however, is also low, sitting at 0.94, which we don't want to see, folks. We would like to see a current ratio of above 1, ideally at the very minimum, but ideally in the 1.5 range and higher. That would indicate to us that they have enough assets on hand to cover those liabilities. Something that's very concerning considering the economic times that we're currently living through, with high interest rates and pretty much a recession around the corner of what everyone's kind of been fearing. Along with that, their debt to equity is sitting at 195%. That's a lot of debt levels there, folks. That means Apple has been leveraging their capital through debt and not through equity, which makes sense given the fact that up until recently, interest rates were at historic lows. So to borrow money was incredibly cheap, and they were making a killing. And it's evident here if you go to the other positives here, like the return on equity. They've been selling phones and all the other Apple devices like crazy. However, due to the earnings that have just been reported, it seems like the ship is slowing down. So those are the 3 categories where they're getting knocked. Everything else is looking pretty good. As I said, they have a high return on equity sitting at 110. Their EPS growth is up by like 500% over the last 5 years, which is massive. They've been buying back shares by around 3% over the last 5 years. The net income is up, the free cash flow is up, revenue growth is up, and the return on invested capital, folks, is sitting at a whopping 38.94%, where on the trailing 12 months, it's sitting at 54%, folks. Ideally, we like to find companies that have a return on invested capital of 10% or higher, and Apple is well above that. It's clearly evident why this is the top dog here in the S&P 500. So Apple's looking pretty good. You compare the company metrics to where they were on a 5-year average to where they currently are, and you can see, as we said, the ROE is extremely high, and in the trailing 12 months, it's sitting at 163%. Profit margin is up over the trailing 12 months. Their EPS is higher than their 5-year average. The only thing that's getting knocked is their price earnings ratio, sitting at a slight premium. It is a $2.5 trillion company. So what can we expect of this company to grow in the future? I don't think it'll grow massively, or quickly rather. So it kind of really disproves that this company should be trading at a premium price earnings ratio. Granted, it's not too high, but a premium nonetheless. Now, what I'm going to do, folks, is I'm going to load different assumptions here in my price analysis section, and we're going to figure out what the intrinsic value of Apple is using historic numbers that the company's been providing us over the last 10 years. I'm going to make some guesstimations from a conservative standpoint, and we'll figure out what we should be paying for this company today. So folks, if you're enjoying the video so far, hit that like button and subscribe button. This software here, if you want to get your hands on it, like I said, follow the links in the description box below, 7-day free trial. So I have it loaded up here, price analysis section. I've done some conservative estimates based off what I think this company is going to do over the next 10 years. And that really just comes stemming down to the revenue growth. It's a $2.5 trillion company. I can't expect it to grow that quick. Profit margin and free cash flow margin, I kept it pretty much the same from what they've shown over the last couple of years, with a slight haircut along with some conservative price to free cash flow and price to earnings ratios. Desired return of 13%. Hitting calculate, it's going to run through all these lovely numbers. And it's going to spit out a price of what we should be paying on average. Well, it's actually going to spit out 9 different assumptions and the average calculation of what we should be paying for this company today. So we'll see what that comes out to be. And the number is 128.37. Look, the aggressive average actually came out to be 156.18. So we pretty much, look at that, almost right down to the penny. If you truly believe in these aggressive numbers, folks, then you're pretty much getting Apple here at fair value. But the average calculation comes out to be $128.37. So that stock price needs to come down just quite a little bit. And we were there at one point. Here, and if you just zoom in to the chart here, June 2022, we hit pretty much 130, and we were just hovering around that range. And look, I believe this company can come down to that point again. I believe it's possible. We've tested those levels in June, and we've tested those levels back in just actually early in January. It was at 125, January 5th, 2023. Look at that. That's crazy. We were there. That's where you should be paying for this company today if you want to assume a 13% return. So what does that mean, folks? Apple currently a little bit overvalued. I guess people are really excited that for whatever reason they missed their earnings, but people want to just buy into this company anyways. But remember, folks, it's about what you pay for the company, and if you are overpaying for a company, it is not worth it. You want to find something that is obviously trading at a discount, because we're all about finding value here. This is a value investing channel. So folks, if you enjoyed that video, hit the like button, hit the subscribe button, and we'll see you in the next one. Thank you so much for watching, and make sure you write down in the comment section below a company you want to see evaluated, or better yet, like I said, get the software and let me know what you thought about this analysis here. So I'll see you in the next one, guys. Thank you so much. If you enjoyed this video, make sure you don't miss out on this stock right here. Now, I believe this might be the potentially best investment going forward in 2023, given everything that's happening.